All right, welcome back. This is session 4 in Unit 10. If you haven't done so, I strongly encourage you to watch the video on Wheeled Coaches, job costing at Wheeled Coaches. First of all, it's quite interesting. Second, it's very relevant to this final chapter in Unit 10, Chapter 12, which covers job costing information. Job order costing allocates cost to products that are identified by individual units or batches. In the case of Wheeled Coaches, that company uses a job costing system to track the cost associated in producing each and every wheeled coach. Job cost records contain all costs for a particular product, service, or batch of products. So at Wheeled Coaches, a job cost record would have all of the cost, direct materials, direct labor, an allocation of indirect cost associated with each job, each wheeled coach. But we also have job cost records in the service industry, in my business, in public accounting. We track not materials used in an audit engagement, but we certainly track time spent on an audit engagement. So for public accountants, an audit engagement is a job. It is a service that they're providing. In a production environment, job cost records would be supported by material requisitions. These are records of the materials used for specific jobs. Also in support of job costing are labor time cards. That sounds like it's a paper document. Clearly in today's world, these are electronic records. But electronic time cards recorded the time a particular direct labor a person spends on each job. So once again, think back to Wheeled Coaches. The very first step was cutting the sheet metal, and there was a person there cutting the metal. No doubt that person recorded when they started a particular job and when they finished a particular jobs, so that the company would know how much time was spent just cutting the metal for a particular wheeled coach. So this is a visual of job cost records. Once again, they appear to look like paper documents, but in today's world, these are going to be electronic records. So these could be the electronic interface through a computer system, or reports produced from the underlying electronic accounting system. The job cost record shows all the costs associated for a particular job. Direct materials, you can see they use, in this case, 6-inch bars, casings. Direct labor, but also notice that there's a line allocating overhead to this particular job. For direct materials, each and every usage is recorded separately on something entitled direct materials requisition. So you see the requisition N41 at the bottom left-hand corner of the screen. You see the details of materials. In this case, there was only one item that was requisitioned, but they wanted quantity of 24 6-inch bars. The system would calculate a report that the unit cost was $5 a bar. The total cost of the materials requisitioned is $120. On the bottom right-hand side, you see the time ticket information for a particular employee, noting when the employee started and stopped a particular work, the amount of hours spent, the employee's rate of pay. Clearly, the employee does not record that. The accounting system would pull that off of its permanent files. But you can see how, for this particular employee, they worked on 2 different jobs, 963 and 571. For job 963, there were 2 different sessions, 3.5 hours. It looks like it's in the morning, then another 3.5 hours later in the day. All right, this is a summary of how information flows through an accounting system. I know for this course we do not want to get bogged down into individual transaction entries, but just a big picture overview. What this slide shows you are three fundamental inventory accounts: direct materials, work in process, and finished goods. Direct materials are items that are on hand, literally in the warehouse, that are materials that are used in production. So for wheeled coaches, this might be paint that's sprayed on the wheeled coach. It might be tons and tons of sheet metal that's eventually used in production. The next inventory item, work in process, represents jobs that are in process at the end of the fiscal period. So for any particular fiscal period, maybe it's the end of the month, or maybe it's the end of the year, most companies have work in process. It'd be unusual where all production is completed and moved out of work in process and into finished goods. And then finally, we have the finished goods inventory. These are items that have been finished. So in wheeled coaches, these are jobs that have been completed. As the video demonstrated, the individual wheeled coach has been inspected more than once, and it's ready for delivery to the customer, but it hasn't been delivered yet, so it's held in the finished goods inventory. When that item is moved out of finished goods and shipped to the customer, at that point, the company will recognize a sale and also recognize the cost of the sale, the cost of goods sold. One final note on work in process. There are three costs charged there, the three costs we've been discussing. Direct materials, you can see how, yes, they purchase direct materials. That goes into a direct materials inventory. But what comes out of the inventory, item number 2, $1,890, is the amount of materials used, and that is the amount that's charged to work in process. On the other hand, direct labor is a direct charge to work in process. We saw on the time card, we identified the number of hours, we have the employee's wage rate, and we charge labor dollars to work in process. And then finally, fixed overhead, or I'm sorry, factory department overhead. We apply overhead to individual jobs. We discussed this in a prior session. There's different methods of applying these indirect costs. The preferred method is activity-based costing. But notice that in this example, they applied $375 of indirect costs, and yet they actually spent more money on overhead. In particular, they spent $392 purchasing overhead. So this could be the purchase of salaries, rent, depreciation. And what they've ended up in this situation is that they have underapplied the overhead. They applied it based on some budgeted rate, as we've discussed, times some actual activity such as direct labor hours. But nonetheless, it's probably impossible to have the amount of applied overhead turn out to be equal to the amount of fixed overhead incurred. So there's always an imbalance. And what accountants do is they take the imbalance, in this case it was underapplied overhead, and write it off to cost of goods sold. Technically that increases the cost of goods sold. Sometimes we have situations where we have overapplied overhead. That's not good either. And we back it out by charging cost of goods sold for the overapplied overhead. And in fact, that reduces the reported cost of goods sold.